Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be Michael Becker, but he is busy closing another transaction. Today, we have our quarterly loan officer roundtable, and it's for the beginning of the fourth quarter of 2016. And in this roundtable, we're going to discuss what's working and what's not working. So we'll also give you some answers to listeners' questions about the capital markets and how commercial loans are structured and closed. So you got questions, and hopefully we got some good answers for you. So joining us in the podcast today, we have the top producing commercial real estate bankers for Old Capital. So let me introduce Ricardo Hinojosa.
How's it going?
Good. Les Meisel.
Hey, Paul.
Dave Walls.
Hi, everyone.
And of course, James Eng.
Good morning, Paul.
So Old Capital prides itself on its profound knowledge of the real estate capital markets. Our definition of success is the success for through our clients and partners. We combine our sophistication of the capital markets knowledge with the decades of experience and demonstrated execution ability. We help you structure the transaction correctly and efficiently to close it on time. You just have too much money at risk, and it's got to be done right. So Old Capital finances 1 in every 3 apartment transactions throughout the state. We specialize in Dallas, Fort Worth, Austin, and San Antonio, and we close between 20 to 25 transactions a month, and we do hundreds of millions of dollars in loans a year. So you'd be challenged to find a better core of loan officers. So guys, welcome to the quarterly loan officer roundtable. Let's kind of kick it off and talk a little bit about what's going on in the markets. I'm going to kick it over to James a little bit. James, what's going on in the commercial real estate market in Texas? Any positives, any concerns going on?
Right. I mean, I think to start, we really need to look at jobs. I think that's the main driver. So you look at Dallas, Fort Worth, really on an annual basis, adding close to 100,000 jobs, new jobs in the past 12 months. And that's really driving the apartment market and then all the other surrounding and complementary property types. And so that trend is following down I-35 to Austin and San Antonio. But where there is a change is really in the Houston market. So the Houston market has only really added close to 10,000 jobs in the last 12 months. And so that is really impacting Class A apartment rents in Houston right now. So the rent growth is flat to almost negative on the Class A stuff in Houston because of the number of units that are being delivered into that market right now. So a lot of these properties were started 12, 18, 24 months ago. And now they're delivering into a market where Class A is struggling, and these properties are having to offer steep concessions in order to get these properties leased up and to hit any sort of pro forma for these developers. So the construction side of the business is definitely slowing down, if not grinding to a halt on the multifamily side. So banks are getting more conservative on the leverage on the construction side and moving into more of the properties that we focus on. So the B and C properties across all the metros continue to do well, and the rent growth in all these markets and these properties continues to grow 3, 4, 5% year over year.
What's interesting, if people are not from Texas, from August of 2015 to August of 2016, Texas gained about 187,000 jobs that are right around non-agricultural jobs, which is an annual growth rate of about 1.6%. And the state's unemployment rate for August of 2016 was 5%. And guys, an interesting stat that I found, which I think was pretty interesting, in 2014, Texas ranked as the 3rd youngest state with the median age of 34.2 years. And it's the 48th oldest state for people older than 65.
Wow, interesting.
Interesting stuff. Dave, let's kick it over to you through the roundtable here. How competitive is the apartment market these days, and what's some challenges that you're seeing out there?
Well, it's no secret that prices have risen dramatically over the last 2 to 3 years, particularly in Austin and now San Antonio. And so a lot of investors are either in the state or out of state are trying to chase these properties. Multifamily and real estate across the board is still kind of one of the number one investments that the capital markets are chasing. A lot of investors are chasing. It's kind of has been one of the only kind of games in town at the moment. However, we're starting to see cap rates compress, and it's getting harder and harder to get these deals to size to the leverage that a lot of investors are wanting to cope with for their investment returns to themselves and to their partnerships. So that's what we're seeing now is we're sizing deals, particularly in the last 3 or 4 months. A lot of these deals are, we're starting to see deals that you have to start looking at 70%, even 65% to make them work. Some of it's helped by 1031 money where they've got to buy something, they're locked into a deal, and they're going in at 40%, and even then, we're struggling to even make some of those deals work. So it's kind of a sign of the times that I think we're going to start seeing some flattening off of pricing across the board in the next 6 months.
So tell me some of the challenges that you're seeing out there. Is there a specific deal that you've seen that has been challenging for you that listeners could get a little bit of an insight of what they should be doing?
Well, we're working on one deal recently where I think it's an example of where we have to be nimble. We have to cope with things that can change very quickly. So we had a property that went under contract, strong borrower. The property was, about 93% occupied. However, about a month into the underwriting, we had Freddie Mac pre-approved the loan, great terms, ready to go. And then, as I said, about 1 month into the deal, the occupancy plummeted dramatically to 60%. That obviously was a no-go for the agencies. So we had to quickly change gears.
Let's stop it right there. What happened when it went from 90% physical occupancy to 60%? What happened?
What actually happened was the owner had a management company that was running this property along with several others, and the management company basically went AWOL due to some in-house staffing issues, people taken off. They really had no one to watch the properties, and there wasn't even a phone number or a sign outside the property to even attract new tenants. So it was a disaster on the management side.
Yeah, so the seller checked out before the loan actually closed for the new buyer. So that's a major issue. So when we talk to people who are buying properties, whether you can put it in the contract or not, but just be knowledgeable that do not have the seller take their foot off the gas. Keep the management company engaged right to the very finish line, because what will happen in Dave's case and what you're hearing here there is it's gone from 90% occupancy down to 60% occupancy. So one loan through the Freddie Mac small balance had it with thumbs up. When it went down to 60%, it didn't qualify because it's becoming a non-stabilized property. So 60% is actually probably that's in distress. And so Freddie Mac is not a distressed asset lender. They're a stabilized asset lender. So what did you do, Dave? I mean, how'd you solve this issue?
Well, we immediately jumped onto several local banks. And, together with a good business plan and a good story, we have secured financing for the buyer on this. And the terms aren't too bad. In fact, under the Freddie Mac program, even though the terms were great, they don't do rehab, as you know. So what we did is we managed to incorporate some significant rehab into this deal with the bank. So not only did we save the deal by getting financing, but we've also got a 12-month interest-only loan for the buyer, and you can also do some significant rehab, which will further increase the chances of getting this thing back into position again, because the property is in a great area. And actually, a lesson here is quite often when a property starts getting into trouble, a lot of people will point fingers. Oh, it's the property, it's the location. 95% of the time, it's the management and the way it's run. It's not the property. So this is a classic example of something that could easily be turned around.
I mean, this is an extreme example of occupancy dropping, but even for Fannie and Freddie, just dropping to 85% can trigger the same issue. So correct. Really working with the seller and the current property management company is very important while going through the acquisition process.
Another good reason why to use Old Capital in the transaction, because if you had gone direct to a lender and they weren't able to close the deal, you'd have to go down the river to find another lender to do it. Old Capital has the ability to pivot and switch companies and make sure that with execution certainty that the transaction could be closed. So that's a good lesson. Thank you, Dave. Let's run over to Les. What's going on today in, let's say, in your market, and is there any alternatives to investing in apartments?
Well, we've recently closed a couple of triple net lease transactions, and we're seeing an increase in those as an alternative to multifamily ownership. They're being viewed as a more stabilized investment with a fairly predictable long-term ROI, opposed to a value add investment with a greater potential upside. However, the financing of these transactions are a little different than what we're usually seeing in multifamily transactions. That's because the primary emphasis in the evaluation is based on the strength of the tenant and the lease term of the tenant. These are usually 10 to 15-year leases with periodic escalation clauses with guarantees from a corporate entity. Now, that doesn't mean that the buyer does not have to have good liquidity, but it is the tenant that is the key component. Great price, great location, great buyer is great. But a bad lease or a weak tenant make it a high-risk loan.
So let me make sure that everyone understands what a triple net lease is. So it's an NNN. So it's the net lease, meaning that, let's give you an example what a triple net would be. Let's say a Family Dollar or a CVS pharmacy or a Walgreens. So as an example, like a Walgreens is the store that's on the corner, but they typically do not own the real estate. An investor owns the real estate. Probably initially, Walgreens wanted to have a store on that corner. They did all the matrix of figuring out what the best location is for rooftops in the area, and they probably built the store. But Walgreens is not a real estate lender per se. They are a drugstore. So that they built the store to what their specifications were, and then they turned the store over to a real estate investor who bought the store, bought the box, bought the real estate, bought everything that's tied to it. The air conditioning unit is owned typically by the investor, but you are responsible for it if you're the tenant. The tenant pays the property taxes, they pay the insurance, they pay everything that's tied to the property. So what we're seeing a lot of is people who own multifamily properties that maybe have owned it for 10, 15 years and have gotten to an age that they don't want to have 100 tenants. They just want to have one tenant that is a credit tenant, like a Walgreens as an example, that they get their payment 4 or 5 days before the beginning of the month automatically wired into their account. That's probably the biggest thing why people do it. Now, the yields are going to be a little bit less than that, but you can leverage it up with debt. Tell me again, Les, who's responsible for the taxes?
In the triple net, the tenant's responsible for the taxes, the insurance, the utilities, the repairs, and the maintenance on the buildings, as well as the monthly lease payment. Now, however, the lending process, kind of going back, is still somewhat similar as we go through, because you do have to go through third-party valuations, the buyer financial information, as well as having some insurance. But lease reviews are very important. And one of the other little advantages, as Paul mentioned, is because of the responsibility, the upkeep of the building by the tenant. You usually don't have to require getting a third-party management company to watch over it and release it and all the additional headaches that some come along with it. So it's fairly good. What's interesting is you might ask, why would the corporation want to pay all these costs? Why not buy them and do it on their own? Well, it's a good question. As Paul mentions, corporations do not want to own real estate. They don't want that on their books. But they do want to have the control of the appearance of the building to keep their company brand as Walgreens consistent across all their stores and not be at the mercy of the landlord to meet their expectations. You go into a Walgreens or a CVS or a Family Dollar almost anywhere, and they're going to look the same, and they want to be kept up the same. Now, this option may just sound too good. So there's just a couple of things that the buyers should be aware of as you're going in. You are dependent on one tenant. You don't have 50 and throw one out and get another one in. You have one tenant. And the facility is usually a single-use purpose structure. So what's there is there. And the rent increases are predetermined for a longer period. These escalation clauses, you know what your rents are going to be for maybe 5 years, and there's an increase and it goes for another 5 years. So it's not a quick in and a quick out. They may not be for everyone, but they do offer another option for anyone's investment portfolio.
I mean, I think this is happening for a lot of companies. I mean, another example, not necessarily triple net, but JCPenney is selling their corporate headquarters right now, right next to Toyota. So, I mean, these companies want to free up space on their balance sheets for the actual business that they're operating. So that's why they do these sale leasebacks. And for an investor, it's a chance to really come in, buy a property, and essentially be hands off, right? So you own it 100%, and then really get a direct deposit the first of the month from a corporation, and it's backed by real estate. So the thing to remember on all these transactions is at the end of the lease, what's going to happen.
Exactly.
And sometimes you can structure the loan so that it pays off the entire principal during the lease. And so you really just have to look at, are you investing in these for cash flow, or are you investing in it for just appreciation? What are you investing in this for, and how does it sort of achieve your investment strategy at the time?
Exactly. They're not for everyone, but they do have the long-term consistent ROI.
So again, if you can't find an apartment building, you still want to get an investment that may work for you, learn and research a little bit more about triple net properties in your area. Ricardo, what's working these days for you?
So one of the things, one of the great aspects of our role is that we do get a chance to work with a lot of, first-time investors and helping them get into the business. It's a great thing, but those can sometimes be the more challenging transactions. For one, you're dealing with new borrowers with no experience. But in addition to that, a lot of times they're buying assets from smaller entities, smaller mom and pop operations where we see a lot of distress, a lot of deferred maintenance, and a lot of times the financials aren't in order like you would see on a bigger property that's professionally managed. So a recent transaction, just to kind of give you a feel for things, we just closed a deal, 18-unit deal in East Dallas. First-time borrower that came to us was really excited about the deal and about the upside. It had a ton of deferred maintenance, needed $8,000 to $10,000 a door in rehab. So the first thing was that, although the borrower had the financial capability, the net worth and liquidity requirements that the lender would look for, he didn't have any experience. So part of our role is to guide the buyers on okay, how do you best structure the deal and what type of strength do you need on your team to be able to get it done. So he was able to pull in a partner that did have some experience. So he had the financial capability and was able to bring in a partner with some experience to help shore up the deal and give the lender a level of comfort to be able to move forward. So that was the first challenge. The second challenge is after digging in, the financials were a mess. And you had kind of a mom and pop operation that commingled a lot of the numbers from other assets, from personal type of financials. So we had to really take a step back and scrub through the numbers and what are we really looking at to be able to show the lender what the true financials are for the property. So again, not an easy transaction, a lot of deferred maintenance, heavy value add in East Dallas. But those are some of the types of obstacles you'll see on smaller deals just because of the buyers, the sellers. Smaller operations do pose some unique challenges.
What were the loan terms on that? Did you close that deal?
Yeah.
What were the loan terms on that one?
Yeah, so the nice thing, we were able to roll in pretty much all of the rehab into the loan. So 75% total loan to cost. So purchase price plus rehab, again, I think it was about $8,500 a door is where he ended up at on the rehab, rolled it all in. His strategy was, again, value add, quick turnaround. So we wanted to tailor the financing to fit his needs. So we were able to find him a solution with no prepayment penalty up front. So he's got the ability, hey, if he's able to accelerate the turnaround in 12 to 18 months, he'll have the flexibility to get out of it pretty easy.
One of the other things that we do to help first-time investors and borrowers is we help them write an acquisition and management plan. And that does two things. Number one, it forces the buyer to really think about what they're doing and to look at comps, to prepare a strategy, look at why they're buying it, the things they don't like, the things that they like. We encourage that and we walk them through it and aid them with that. But the other advantage of that is when you have a first-time investor and you go to a bank, it looks far more professional. It makes a better impact on the bank's underwriters when they see a professionally written acquisition and management plan, and it can really help get the deal done.
Absolutely. That's totally key. So we're able to bring it together, get the deal closed with pretty good terms for the turnaround plan. So that's just, again, an example of some of the work we do with first-time buyers. We do that every day.
Congratulations to Ricardo on another acquisition. Just closed on another deal. As we say, not only are we good at debt, but we're actually in the business of owning multifamily properties, office, retail, things that we actually have some great knowledge on because we do it. So what did you buy?
Yeah, so just closed on a 1985 multifamily asset, 208 units in Waco, Texas. Myself, along with a partnership group, actually just closed yesterday. So we're excited to get it kicked off. Pretty big rehab project. We've got professional third-party property management in place that's going to help us kind of get through that. So we're excited to get started.
Excellent. Good job, Ricardo. James, what's going on in your world?
I think another thing that's coming up a lot in today's market is really around assumptions and prepayment penalties. So a lot of deals that were bought maybe in 2013, 2014, they've been rehabbed, and now the market has improved so much, rents have increased so much that people are coming and bringing these deals to the market for sale. And a lot of times these had 10 or 12-year debt on it already. And so now listing brokers are having to present these deals with assumptions. So a lot of buyers are coming to us and saying, well, should I assume the loan or should I buy it with a new loan? And the two key components of that really come down to what is the existing terms of the loan, and is there any interest only left? Is there how much term is left on that first loan? And then the second thing is, if you do prepay it, how much is the penalty, right? So sellers are going to do, at the end of the day, the seller wants to know what's my net coming out of closing, right? So whether I prepay the loan and you pay a little bit more, or you just assume the loan. So I think that analysis is getting more difficult for buyers. And so that's something that here at Old Capital we can help you with. So we can go through the analysis and figure out how much the prepayment is and how much it's going to cost for the seller. And then you're able to present that information to them if needed, so that when you make your offer, whether it's, with new debt or with the assumption, you can come in with all the information and make the best offer based off the information.
Yeah, an excellent point on the assumptions. We are seeing quite a bit. I was at a property yesterday where the two properties that the buyer was looking at both had to have the loan assumed, because if they did not assume the first one, it was a $1.7 million like a prepayment penalty called defeasance. The second one was an $850,000 penalty. Now that penalty that dollar amount just goes poof. It doesn't go to the seller, does not go to the buyer, doesn't even go to the property, it just goes to the bondholders. So assuming a mortgage is, not all transactions are going to have assumptions, but the ones that have assumptions, you really need somebody to hold your hand to get the assumption through underwriting, because it's like doing a brand new loan right out of the box, and you just don't know what the seller looks like. That's why you need help to have, somebody like Old Capital kind of talk to the underwriter to kind of figure out how strong that person is, versus you going in there blind, because they're not going to tell you that information. They'll probably tell us because we're kind of on the same team as them. We're trying to put the transaction together. So you really want to have somebody help you on the assumptions and the supplementals too. Dave?
Yeah, just to add to what Paul said, you got to remember that when you do an assumption, you are stuck with the original lender on that loan. You can't go and shop an assumption. If you're doing a new loan, we have the ability to talk to many lenders and get you the best deal. But when you're doing an assumption, you are stuck. You're tied to the person that did the original loan. So therefore, Old Capital can help you walk through the fees, walk through the charges that they're going to charge, and try and help you do the most efficient job that you can on the assumption.
So another thing to remember while you're going through that process is that a lot of these loans you can take the assumption, but then also get a supplemental loan, which is an additional loan up to 75% of the purchase price, as long as it appraises for that. So when you're doing your analysis, make sure that you're taking that into consideration, because a lot of these assumptions are at 55 to 65% of the purchase price. And so that makes the numbers hard to get to in terms of returns. So a lot of times we're able to add a supplemental on top of the loan that you assume.
Good point. Anything more to add, James, at all?
I think that's it. Right
Okay,
now.
so during the months between roundtables, we get lots of listener questions. So make sure that if you do have a question, just go to info@oldcapitallending.com, info@oldcapitallending.com, and just write us out what the question is, and we'll try to answer that directly with an email, or if we think it's important, that we'll bring it to the roundtable and have everybody kind of visit on the transaction. Question I have for the guy who just closed the transaction himself, this is from RM. Can a borrower use a self-directed IRA for equity in a transaction? So Ricardo, what's the answer to that question?
Yeah, common question. The question is, can they bring in 401k, IRA funds as equity? The answer is yes. Through a self-directed IRA, you can come in, and the deal we just closed, I think we've got 3 individuals that came in with self-directed IRA funds. You got to make sure that you've got things set up ahead of time and you're ready to go. So when the time comes, you're ready, because there is some setup time and process, time in there, but absolutely, definitely doable.
I guess the nuance on that is also, can they use that for their own transaction, or these people? Okay, so for this listener, just understanding that you can set up your self-directed IRA and invest with somebody else,
Correct.
But you cannot use your self-directed IRA to invest in your own deal.
Correct.
Yeah,
Correct.
You cannot sponsor your own deal with IRA funds. The lender may not have a problem with it, but your uncle, as in Uncle Sam, is going to have a problem with it. You cannot put your own personal money. You cannot guarantee it. So you cannot be a KP or a guarantor in the transaction. Now, if you want to put those monies passively or as a limited partner into somebody else's deal, not a problem. But also when there's income that comes, hopefully when there's income that flows into the property and gets distributed into the IRA, it has to go back into the IRA. It's not going to go back in your pocket. It's going to go back into the self-directed IRA. Anything more to add to that, guys? All right. So we see quite a bit of that, the self-directed IRAs. James, let me just ask you a real quick question. This comes from listener AP. Can a foreign national buy an apartment building?
Absolutely. So we work with foreign nationals a lot, and there are certain loan programs that are available for foreign nationals. They do have different requirements. So for example, on a Freddie Mac loan, they would need 2 times the loan amount in net worth, and then about 20% of the loan amount in liquidity. So some of those small differences, and then we structure the transaction up front, so they have third-party property management the majority of the time, depending on their experience. So just understanding what the foreign national wants to buy, we have a few loan programs that work for those individuals.
Let me go back to you, James, one more time. Listener MD asked, do you guys do student housing? So do we lend on student housing? And really, what is student housing? Let's kind of talk about that, James.
We do. I mean, the thing you have to remember about student housing is that, let's say a student housing in Austin on West Campus, there's definitely a pre-lease cycle. So understanding what the pre-lease for that building is and currently is, because after school starts in September, then nobody else is leasing until the next school year. So if your occupancy is 85% in September, that's what it's going to be for the next 9 months. And how you underwrite that is very different than just a normal multifamily that has no seasonality. So we definitely do student housing. It is underwritten more specifically by Fannie and Freddie. So the leverage might be, instead of 80% on an acquisition, maybe 75. And then they're going to be looking at things such as distance to school. Are you on a bus route? How are these students getting to campus? Because what happened in the recession in 09 and 10, say, for example, in Austin, was anything that was next to campus had the highest premium. And if those guys dropped rental rates, then all the surrounding areas dropped along with it. So they want to understand how these students are getting to campus, and then who is your immediate competition in the area.
And one of the things also, too, is that how is the students going to pay you? Because you're really underwriting somebody that does not have a job.
Right. So no job, a lot of credit cards probably, but no job. So most of these student housing projects are backed by parental guarantees. So they want to see typically 100% of the leases as parental guarantees. And then you want to look at the term of these leases. So as people, let's say in August or July, these student housing developers will start signing 9-month leases. And then all of a sudden in July, you wake up and your building is 50% occupied because everybody has left Austin. So understanding the lease structure and the pre-lease is very important, and underwriting that into your model up front. And then also the last thing on student housing probably is just your repairs and maintenance. Just understanding how hard these students are going to be on your units is very important.
Yeah, and sometimes it's when we underwrite these deals, it's not typically on per unit, it's on a per bed basis. So that looks a little bit different. And then also too, just like James was saying, is it a 9-month lease? Is it a 6-month lease? Is it a 12-month lease? You got to look into it and have that, make sure that gets defined by you, and who the management company is a big thing on student housing too, is that we want to make sure that you have somebody that has done student housing before, that this is just not their first rodeo, that they understand about the demographics of fair housing that comes to student housing, things that are very dynamic in the student housing business. Make sure you get a qualified management company on that one too.
There was a lot of underwriting nuances in that response from myself, but the positives of student housing are, look, you're always going to have renters next to these campuses. And so it's just going to be, the demand there is constant. And so that's one thing that people like about student housing, that is, if you buy something next to UT or UNT up in Denton, I mean, the demand is constantly going to be there, and the enrollment in these universities is constantly growing. No,
absolutely. And that, I think you may have mentioned it before, we have another listener talked about what does it take to build an apartment building? AS asked the questions, what does it take to build an apartment building? That's a tough one these days. So just like we talked about a little bit before, we don't think the economy is slowing down, but we definitely see pressure by the feds to try to have the banks limit the amount of construction and new apartments out there. That our feeling is that only the best borrowers, the best sponsors are getting the transactions to be closed out there. They're getting the opportunities because the banks have limited funds, and they're not typically right now going to take a flyer on somebody who's never closed before. So if you're looking to build an apartment building, the banks are right now pushing back to a certain extent. Another way of getting it done is through FHA, but FHA is very particular too on new construction. You have to get approval through FHA. You do a pre-application committee meeting, and you kind of figure out if FHA has other properties that they own or sponsor in that area and how those properties are doing. So, they're funny that they don't want too much exposure in any one area. So now they'll require less money down on these transactions, and they're typically non-recourse with 35-year amortizations and terms. They are a good way of getting things done. But the bucket on FHA is filling up. The bucket on just conventional construction on apartments is also filling up too. So anything more to add on that, James?
Yeah, probably 2 years ago, we were seeing, full leverage on construction loans, maybe 75%. Now it's creeping down to 60%. 55, 60%. And then the guarantors have to be extremely strong. And this is, not their first transaction.
That's right. Dave, listener BA wants to know, in your opinion, what are the most profitable type of apartment transactions? What is the most profitable type of apartment transaction? Is it going from a C to a B? Is it a stabilized property? Is it a value-added property? What's the most profitable for an investor these days to buy into?
It's really deal-by-deal basis. Someone could buy a well-located C property in a certain area, which has great dynamics in terms of tenant base and jobs, and that could be way more profitable than a guy running out and buying what you think is a very nice B property. It's really deal-dependent, but what I think is generally a lot of investors in the long term end up making better returns on a well-positioned C property in good times and bad times, because when things start getting tight, the larger, more fancier properties, if you like, the A properties start offering concessions. That makes people move from B to A's. Wow, I'm getting a great deal here for just a few dollars more because they're offering concession. Whereas in the C property market. It's a different sector. It's workforce housing. It's blue collar workers, and a lot of those people will never ever end up buying a house. They'll always be renters. So I think, in terms of looking at all the three classes, I think that the C property, as long as it's well located, maintained correctly, is kind of your best bet for returns. James?
That's right. I mean, when you're looking, let's say in Dallas, Fort Worth, an A class might be a 5% cap rate, a B 6, and a C a 7 in today's market. So your cash on cash can be double digit going in on a C property. And I mean, you make money on the buy. I mean, that's how you do it. So I mean, regardless if it's A, B, or C, the transaction, you make money on how you purchase it and in comparison to your surrounding properties, right? So we like to see someone buying something where they can add some value, whether it's management play or interior exterior rehabs.
In the Dallas-Fort Worth market, let's kind of define what a C property is. Ricardo, in your mind, what is a C property? What does it look like? What area is it going to be at? Tell us a little bit about what a C property in your mind is.
Yeah, so the first thing you think of with asset classes is age of the asset. So Cs are usually going to be 70s or older when you think of DFW. Usually, again, older, location-wise. You'll find C assets pretty much all over DFW, but primarily in the core DFW. So a lot of the suburbs, you'll find more of the newer assets, B and As, that are 80s and newer. So age, location are the two primary things that come up when you're talking about asset classes.
What type of amenities in the property?
On a C, it's going to be pretty bare minimum. You're going to have a pool usually with a good size asset, but you're not going to see some of the things that you see in Bs and As, right? Usually you're not going to see it like a fitness center. Clubhouses will be pretty basic, if any, maybe a playground or two, but pretty bare minimum on Cs.
Yeah. So Ricardo's absolutely right. If you go back to 1960s and 70s, where you're going to find a lot of the C-class properties, you just kind of have to look at a map of what, let's say Dallas looked like back in the 60s and 70s and what the borders were. And they were just the core properties in the Central Business District. They were in South Irving area, areas of like Valley Ranch or even Flower Mound, Louisville. Yes, there were towns, but in the 60s and 70s, that was the Wild West out there. Areas of like Plano, East Plano off of 75, that core area right there, that was probably started to come in probably by 1960s, 70s. And then in the 80s, we had a big boom of apartment building that went out to Garland and went out to Rockwall and Rowlett. The famous I-30 corridor, where a lot of these apartment buildings were built because the savings and loans were just giving money away for apartment builders to build the properties. And so, those properties that were built in the 80s, individually metered properties, probably had a tennis court, and that's one of some of the things that you see in the 80s properties, the tennis courts. The property you just bought, does it have a tennis court?
The one that we purchased earlier this year does. Yeah. And that was a challenge. Those are big challenges.
Yeah, so just like golf, I just saw a statistic that 20% of golf is down this year. I mean, who plays tennis in an apartment these days? I mean, that's not the demographic that's playing tennis. So what do you do with a tennis court? So
you got to get creative. You got to get very creative.
You got to get very creative on that type of stuff. So a B property is going to have amenities to the property, and then the A properties. We're not, the people that we're talking to are not buying typically A class properties just because I don't know how they make money in these 4.5-5% cap rates, if that. Sometimes 4%. I mean, that's a low number. The only people that are really buying those properties are institutions, low leverage type of stuff. That's not people who are trying to make a huge amount of profit. Anything more to add to that, James?
A couple things. I think going back to the A, B, and C, a lot of people get hung up on the age, maybe sometimes the construction type, but at the end of the day, it's about the rent. So, the C properties in Dallas are really probably about 85 cents to $1 a foot today square foot per month. B's are in $1.15 to $1.25 per square foot per month, and then A's really, if you're commanding $1.40 to $1.50 per square foot per month, that's really the difference between those properties. So if you're able to command those rents, that's your class. And then the reason that I see some people actually moving towards higher quality stuff, whether it's B or A, is that cap rates are getting so compressed on the B and C stuff. So they're moving the A's because they're saying, well, do I buy something that was built in 2012, 2013, 2014 and, buy it on a 5 cap, or do I buy a C quality 1960 product at a 6.5, right? That spread between A to C is getting tighter and tighter, and not necessarily has not come down as much on the A stuff. So some people are willing to take that lower return for higher quality product. And so the newer stuff might have, 9, 10-foot ceilings, the amenities are a completely different level than even the 80 stuff.
Right. I mean, the things people make money on these properties on a cash-on-cash return, what type of rate of return are you making on your money on a monthly basis? Is it evaluated property? I may defer some of that cash-on-cash return, waiting for the property to be stabilized, and maybe I can make a 10, 11, 12% rate of return on my cash-on-cash on a monthly basis. But then I'm looking for what that IRR is. I mean, how long do I have to own that property to try to make a 20, 30, 40% rate of return on my money? And how does that happen? Well, we got to increase the NOI on the property. We have to maybe have some compression in the cap rates too. So, and that's why, apartments have been such a favorite part of people's investments for the last, say, 10 years or 7 years or so since the Great Recession, is that those cap rates have come down, that compression. Even a blind squirrel, 7 years ago or 5 years ago, if they invested in apartments, could make a killing. Now it's a little bit more challenging to get it done, and you really need help, whether it's a mentor trying to help you find the right property, right area, and you definitely need help in the capital markets, and that's where these guys at Old Capital definitely come in to try to help you. And if somebody wants to get into apartments, what's the first thing that they should do on the lending side? How do they get to know you guys? So James, let's walk around the table.
Sure. I mean, I think the first thing is really to get educated around how apartment financing works, right? So start learning the terminology. We have a 10, 15 page white paper that walks you through step by step on how to analyze these properties. So that's number one. And then number two is, we can sit down with you and we'll go through a personal financial statement and sort of put everything together. What's your balance sheet look like, your income statement, and figure out what type of loans you can qualify on your own, and then possibly what type of partners you would need to bring in to round out your team. So I think those two things really get people started, is the white paper and then also putting together your personal financial statement.
So then people always ask me too is, where do you guys get your data from? I mean, what do I have to sign up for to get data? Well, there's a couple of good websites out there that are free, or that you have to pay a minimum cost to do. Of course, you can go to LoopNet and kind of figure out what's going on with properties out there. I kind of call it the People magazine of brokerage business. It gives you kind of a quick snapshot of what's available out there. There are properties that trade using LoopNet on there. But if you're looking for real hard data about what's going on, probably my favorite website, if you're in Texas, and it also applies for information around the United States too, but Texas is a core, is the Texas A&M Real Estate Center website. The Texas A&M Real Estate Center website. And that's been around for a number of years. They have economists on there that they share data about what's going on down in Texas, but on a national basis, talk about housing, talk about real estate, talk about land prices, talk about occupancy. Just a great website. So make sure you go on the Texas A&M like A&M University, the Real Estate Center. So look at that. Another one that I like, which is you may have to pay a nominal fee, but call them and see what that's all about, is the ALN data. ALN data. So ALN data gives people kind of a general overview of their market. They originally came out of Dallas. It was for people that wanted to get information about apartments. They were in apartment leasing. And apartment leasing built a huge database, and bankers and people that were interested about finding out what was going on with leases and costs and tenants and things like that all subscribe to this database. So ALN gives you an opportunity to figure out what the occupancy is in a market, what the asking rents are, what the effective rents are, if there's any concessions in the market. And so it's they may run 50 to 100 markets or 400 markets in the country. Go onto their website, ALN Data, and they do a great job of giving you up-to-date information about what's going on in the market. And I think if you pay them a fee, they can give you what's going on in the sub-market itself too. So, a great thing. And then things that I think are interesting that maybe some people don't, but I think that, when people ask us, what's one of your hot buttons? One of my hot buttons are, people always ask, are banks interested in my rate of return on my investment? And the answer is no. They're only interested in them getting their money paid back. And so one of the things I've seen recently is that these properties have done very well, but there's been a lot of deferred maintenance on the property, and a lot of the sellers have not fixed their properties as much as they can, but they keep telling us, well, the property's at 98% occupancy, it's doing well, month over month after month, we're paying out great dividends. But the problem is a lot of these sellers have been using these as ATM machines, not really putting the money back into their property. They've been distributing their monies back out to the partnership. So that doesn't help me in my argument. If you're refinancing, that you're paying in a small syndication, you're paying your partners. I want to see the properties maintained nicely. The bank is your largest partner. Pay us back our 4.5%, whatever that cost is, but maintain our asset. I don't want to see a lot of deferred maintenance on these properties. And I'm getting off of a tangent, but that is my pet peeve, is that if you're refinancing a property, make sure your asset looks nice, please. Thank you. James, anything to add?
I think going back to market data, another source is CoStar that we utilize. And so CoStar is, to me, the 800-pound gorilla across property types. So they really started in office retail, in that market, industrial even. So they have data on every tenant in every building across the US. And so they have gotten into the apartment market, and we can pull data down to the submarket, down to the property level. So they control apartments.com to some extent. So they have the data on what people are advertising and the pictures around those properties.
Yeah, so. And then they also own LoopNet too. So if you do want to get data from CoStar, contact CoStar. There's going to be a fee to get their data, but I think their data is probably the best that's out there. And make sure that, tell them that Old Capital recommended you to go talk with them.
So another thing also just around when you're going in for a refinance on property, I mean, these lenders are not only going to look at the condition of the property, but the condition of your other assets in that market. So make sure that, when you're looking at your portfolio, understanding how your properties are performing across the portfolio, not just that one individual property.
Absolutely correct. Dave just had a transaction that was a problem, but we'll go into that next time on the condition of the asset itself. That's what triggered my head. So let's finish up the roundtable. Anything more to add to the roundtable, guys?
James' comment is very good as coming in, and just to add to that is as Ricardo mentioned, for new buyers, kind of know your strategy or work with us on your strategy. Is your strategy to own one unit, 10 units, 2,000 units? So that helps us know how to structure what the first, second, and third steps are as you move forward. So if you don't know it, work with us on your strategy.
Great idea.
I think a lot of it also, when you come and talk to us, talk about your team and who you've already talked to in terms of property management, your attorney, your accountant. And if you don't have those people on your team, ask us for recommendations, because we know who is closing loans and closing transactions and have been through the process. So instead of bringing, your brother-in-law who has done one transaction, let's find someone who's experienced and professional and can get these deals done. And
has a name in the marketplace too. So, guys, thanks for hanging out with us in the Old Capital Podcast Roundtable. We'll do this again probably the first of next year. Anything more to add to what we should be promoting out there, James? Sure.
I think a couple things. If you want to get the white paper, the Old Capital white paper on apartment financing, email info@oldcapitallending.com, info@oldcapitallending.com. And if you like what you're hearing from our podcast, please go into iTunes and subscribe, and then also leave us a 5-star review. That helps us not only get more guests and more views, but then also provide you better content on this podcast.
Fantastic. All right, guys, thanks for hanging out. We appreciate it. And thanks for listening to the Old Capital Podcast.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.